Hi everyone, welcome to this live show. As usual, I will be sharing with you my views of the market for these days to come, both technically and fundamentally. So, as usual, we will start sharing with a calendar for this week. It's a quite interesting week from the fundamental point of view because we have plenty of central banks making or having, sorry, monetary policy meetings this week. And of course, we have non-farm payrolls Friday coming from the US. Yet, yet the market is still rolling around Trump's recent taking of the office and all of his new announcements and how is he doing with his policies. Pretty much the market is a bit disappointed because he's quite focused on immigration and banning and protectionism in trade. And the market is eagerly waiting for some tax benefits announcements, any measure that can actually point to boost growth and inflation, something that he sort of promised in her victory speech, right? But so far didn't compliment. Anyway, speaking of central banks, the Bank of Japan was the first one. It had an economic policy meeting in the past Asian session, right? And well, there were not much news coming from there. They left the economic policy unchanged. They left their forecast inflation and growth perspectives also pretty much unchanged. A slight review. For the most, I do believe that Mr. Kuroda is hoping or relying on U.S. growth policies, upcoming policies, to boost growth and the greenback and therefore maintain the Japanese yen view. Still, we had some positive inflation readings coming from Japan last week. It fell by less than expected, but overall, keep in mind that inflation is still far away from the 2% target that the Bank of Japan has, and that the recent measures that include curving yields long and short term and maintain the differential close to zero, as Kuroda said, is not proving to work much more than the rate cuts or the easy, right? So I don't know. I don't know which other tool central bank may use, but at this point, I do believe that the only thing that can do is rely on motor strength. Okay. Anyway, also news earlier this week, we had inflation in Germany, and I know that it's color red because it's below market's expectations, but I was taking a look at the year-on-year inflation, right? Both the German one itself and the one harmonized with the rest of the euro area came up much better than in the previous month. Somehow we are having signs of rising inflation in Europe. We had also today the release of the euro area inflation that also came better, much better than expected, and much better than the previous month's reading, right? So I do believe that the euro will find some support in this inflation readings because the market and not the ECB will start thinking about tapering. We have yesterday some comments from ECB's Nowanti, who is Austrian, right? Council member, who said that the bank will probably review its forecast and perspective and monetary policy, in their June meeting, right? But that they won't likely discuss taper at that time. That's why the euro fell to 619 yesterday, but it quickly recovered around, right? So anyway, a positive ECB, a hawkish ECB backed by strong inflation and growth ratings in the euro area, something that we had this week, right, will make the market consider the possibility of tapering, and that will strengthen the common currency. Okay, ahead for today, we don't have too much relevant data. I believe that consumer confidence in the US could be a market mover, but not much, right? And later today in New Zealand, the employment readings are usually relevant in Asia, but they hardly affect the rest of the market. After 15 years watching the market, I can remember just one time when a central bank or an employment figure, I'm not quite sure about which one was, but just one time, a big release in New Zealand was able to affect the rest of the Forex market. So the influence of this particular report will probably be seen mostly in the Australian dollar, and of course, movements will be far more limited than the one in the Kiwi against the greenback. On Wednesday, we have several relevant readings, manufacturing, final manufacturing, and non-manufacturing readings in the euro area and in China. Remember that China, Chinese markets are closed this week due to the New Year's holiday, right? So pretty much not much trading volume in Asia. But anyway, news will probably affect the market, and as usual, Chinese figures will affect particularly the Aussie. But anyway, we have several final reviews of manufacturing in PMIs in Europe. I believe that's the most relevant. I don't expect big changes, not much disappointment. There are slightly downward revision expected in some cases, but minor ones, not really relevant. Okay. The only thing that the thing that will be more relevant will be the final services reading, not this one, because the service sector seems to have slowed the pace of growth at the beginning of this year. Still, economies are pretty healthy, further supporting the case for a hawkish ECB and the case of markets thinking about tapering before the ECB thinks on it. Anyway, of course, the most relevant thing tomorrow and what the market will probably wait for is the Fed's monetary policy meeting that will take place tomorrow in the American afternoon. To be honest, we are not expecting any changes in the policy. This is what we know as a non-live meeting, which is that there are no press conference, no forecast, just the numbers and the statement that is released for the market to read. The Fed does not usually change as much the wording of their statements, but in the latest meeting, right after Trump's victory, we have noticed that they use a lot the word uncertainty. The Fed these days, it's Trump dependent. We are not more data dependent. We are now Trump dependent. Upcoming policies, and I mean coming from the Fed, will depend on upcoming policies coming from Trump. I was also remembering before starting this coverage that during 2014 and 2015, the dot plot promised or suggested 4 rate hikes for the next years, meaning 2015 and 2016. And the Fed just delivered 1 rate hike each year, 2 rate hikes in a decade. So while last December we get pretty excited because the Fed foresees 3 rate hikes for this year, the fact is that the market is, as me, realizing that whatever the dot plot says is not what the Fed will do at the end. So it's a wait and see stance there. And if we see more of the uncertainty that we saw after Trump's victory coming from the Fed statement, well, I do believe that it will put the greenback at risk because at this point, the market is just considering the possibility of 2 rate hikes, June and December this year, right? We are quite early in this 2017, but still the market is betting that the most what we will get from the Fed will be those 2 rate hikes. And tomorrow's statements may give us some clues of whether that's real or not, or if they are serious about the 3 rate hike case, okay? Anyway, I don't see much good news for the greenback coming from the Fed tomorrow, to be honest. Anyway, to be honest, it's my view, okay? On Thursday, we have a super Thursday. The Bank of England will have its monthly, not anymore monthly. I do believe that they have flipped as the rest of the economists to 6 weeks in between meetings, right? Anyway, their monetary policy meeting. This one is quite relevant because it's one that includes the Bank of England quarterly inflation report, right? And of course, as usual lately, we'll have the minutes of the same meeting. Um, Inflation has been rising and rising and rising ever since the Brexit referendum, right? So there is a limit, and the Bank of England said, to what they are willing to tolerate in higher than their target inflation due to this chaos. The fact is that right after the Brexit vote, Governor Mark Carney rushed to cut rates to record lows of 0.25%, okay, anticipating to the probable market chaos, financial chaos, it will come with the Brexit. The fact is that data was resilient, there was no financial, no economic chaos, and now looking back, the move seems a bit too much for the time being. And maybe, just maybe, there's a chance that the Bank of England will need to review that decision and revert it. Of course, that's not something that will happen today. The market is estimating it won't take place this year, right? We are not going to see a rate hike coming from the UK until 2018. I don't know, to be honest. I do believe that Brexit has a lot to say during the upcoming months. We have to see if mm, Prime Minister Theresa May is able to trigger the Article 50 late March as she wants, right? With the Parliament approval now. And in that case, we need to see how the economy reacts to it before thinking about what Bank of England next move will be. Overall, we're expecting a wait and see stance, no changes in the APP program, no change in rates, no change in anything, but maybe within the quarterly inflation report, we can see some revisions to inflation. If those revisions are towards the upside, that will be pound positive because it will mean that the bank will have to rise rates before 2018. Okay, so pretty much that's the case. I'm not sure if we are going to see too much action also with Bank of England. Lately central banks have gave up the first place at market as market movers to politics, right? So yeah, let's see what we get from this. Anyway, and on Friday, of course, we have the revisions of the services PMIs. Remember what I said about this ones. We have weaker than expected figures. The service sector is the one now posing a challenge to euro area growth. So beware of downward revisions in here to affect the euro maybe more than usual, okay? If we have downward revisions below previous and market expectations. Anyway, another start of the week, the non-farm payroll report in the US on Friday. You know, guys, we are not expecting much changes. We're expecting the economy to add around 165,000 new jobs, slightly below the previous one, which was a bit of disappointing, but still within our average. The unemployment rate is expected to remain steady. I will pay special attention to wage as usual, because last month on December uh, reading, which shows November data, right, showed us that in November salaries grew more than expected, 0.4 monthly basis, 2.9 yearly after being around 2.6 for long. So those are good, really good numbers, and somehow we are indicating that the U.S. economy is growing. Okay, higher salaries, more consumption, more inflation. So we are heading to the right path towards rate hikes, right? That's how the market reads the reports. Anyway, what I'm trying to say is that we have steady figures near this level, 0.4, 2.9 above expected. That will be good news for the greenback. Okay. Another thing that I am following these days is the sorry, Baker Hughes oil rig count, right? It has been steadily rising, and we are about 68, I do believe, active oil rigs above what we had a year ago in the US. oil prices, we are going to take a look at the chart now. Oil prices have been steady because despite that sort of saying success that the OPEC is getting with oil output cuts, sorry, the fact is that U.S. Production is growing at the fastest pace. So that is offsetting any positive news coming from the oil market, and that's why we see oil unable to move far away from the 50-52 region. Um, if the rig count in the US keeps rising by the end of this week, it's usually published late Friday, as you can see, then that will probably weigh on oil prices at the beginning of the next week. Okay, that's something to take into account when you start trading Sunday afternoons, whatever you are in the world. Anyway, let's change the charts and see what's going on and which levels we should take care of. Okay, give me a second. There we are. I hope you're seeing my charts. Yes, I guess you are. Okay, I didn't notice the euro advance when I was speaking. Something probably happened and I'm not paying too much attention. But anyway, what seems interesting about the euro is that it's unable to fall. If you take a look, higher highs, higher lows, everything is pointing for an upward continuation. What's preventing the pair from advancing is the daily chart of 100 simple moving average. As you can see, it has been steadily rejected from the level since early last week, and there we are challenging it at the weekly high 740. I would like to see a pair breaking above those highs we said last week about around 770, and that will lead to a recovery up to 840, 820 region. We have the 50% of the November-January slide there, and of course 840 is a major static support area back from 2015 and 2016. So that's for now my main bullish target in the euro dollar. I do believe that it will be a tough bone to break 840, that region. We may have a spike above it, but then the price should quickly reverse below it. In the other case, of course, if the level is taken, then I do see the pair advancing firstly towards this 930, 940 region where we have the 61.8% of the rally, and even further towards 110. Okay, short term, this 650, 660 area, right, seems to be quite support, right? Take a look at the chart. We have relevant highs and lows in the area, and unsustainable spikes either side of it from those past 2 days. So a break below that level, a candle open above below it, something that is unlikely right now, okay, could drive the pair down to 600 and even lower towards 565, which is a 23.6% retracement of the mentioned rally. And for me, it's like a line in the sand. You know, I do believe that even though the pair can fall down to that level, it won't be losing this bullish momentum we are seeing these days, although sly and slow and steadily rising. Below that level, the risk will clearly turn towards downside for me, and the pair will have scope to fall around 100 pips and test the 450-60 region. Also, quite interesting comfort zone the pair had late December. Okay, right now 770. It's the key, right? If we can break through those heights, there's scope for further advances. And when it comes to pound, the pound has been quite weak these days. Today's decline was triggered by poor monetary and credit figures coming from the UK, so how suggesting that people are starting to be concerned about rising inflation and the Brexit situation, right? Anyway, as you can see, the pair fell to the pip towards the 38.2% retracement of its latest bullish run at 2410, which is for me the main and immediate support. If it handles this area and reverses some raw dollar weakness and surpass this high, I do see a scope for the pair to test this 25, 10, 20 region, right? I do suspect that we may see some selling pressure if we get up to here, but if it doesn't, then if they don't come, then the pair has scope to resume its advance and retest the 26 region. Still, and with Brexit looming, I don't see how the pound can break higher, right? I do believe the market will take this upward moves as opportunities to sell. And on the other hand, if this level scales up, 23.30 is a huge static support level. We have a 50% retracement of this rally nearby. So that's the next bearish target. If below 24.10 and below 23.30, then we have a FIBO and some lows around 22.50, 60. So that comes next, okay? But for most, I'd see the pair bearish. When it comes to the OC, the fact is that we have that strong recovery and now some consolidation. It has been rejected from 76, but it's holding above 75. So we need to leave that range to set some clear directions. So far, what I see here is some consolidation. Nothing is telling me that the pair may fall or may rise again. That's what I'm looking for, a break of such extremes, right? And what's keeping probably the pair range out is the fact that we have China on holidays. And without news coming from there, there's not much action going on around the OC. Anyway, with the upcoming data, manufacturing and PMIs released over the next session, we may get some action in here. Still, I do believe that the downside is needed by 74.15 for me. It's a major static support level, and it has already proved strong this January. So unless the pair breaks below this level, the bearish craze is denied for me, okay? I would like to see the pair breaking below that level before considering the short. And when it comes to the Japanese yen, despite it has also been ranging and lacking certain direction, the fact is that the risk has turned towards downside, and we need to take down the 12th level, 112th level, before considering a sell movement here, right? There was sort of a double floor, short-term double floor around 12.15, 12.16. The pair bottom around the level last week and the previous one, but the upside seems also contained, right? So not much action going on in here. I believe, as I said, that the risk is towards downside below 13. 12.50 is the next support ahead of 12. And I do believe that that downward acceleration below this level can take us pretty much towards 110, okay? Towards the upside, to be honest, unless the pair can regain 1660, right? There's not much bullish potential, and it seems quite far from the level with a lot of intermediate resistance in the way towards 1660. I will take a look at gold. I was a bit surprised yesterday. Was yesterday? No, sorry. Yeah, at the end of last week, sorry, on Friday, when we have that spike of risk appetite sends stocks sharply higher, right? And gold wasn't able to gain much ground. The situation is, sorry. Again, we have this spike of risk aversion and stocks plummet, right? It was earlier this week, and the commodity wasn't able to rally, okay? That's what I'm trying to explain. Despite the yen gain, safe haven gold was unable to recover ground, and we have down plummeting over 200 points yesterday, closing off the lows. But anyway, showing that risk aversion is back in fashion among equity traders. Anyway, the fact that the gold wasn't able to rally, right? I believe it's somehow telling us that there's some upward exhaustion in here. And of course, the market will probably be in wait and see mode ahead of the Fed because, believe it or not, gold keeps maintaining a high correlation with whatever the Fed says. If we have a hawkish Fed, then the commodity will probably fall, and a more conservative Fed will likely push the prices back higher. Okay. Anyway, don't see much of an upward potential in here as long as we remain below the 12.04, 10 region. That area seems a nice resistance area. So only above 12.10 we can see a recovery up to this 20 region, and above it, as we mentioned last week, 30 area comes next, 30.32, where we have relevant highs in the next Fibonacci resistance. And towards the downside, I do believe that we have a strong support around 11.91.90. So only below that level, I will consider sell. Sorry. And towards 11.80 and even lower towards 11.73. And finally, what I was saying about oil, if you take a look at the daily chart, trading has been quite choppy since early December, not much definitions in here. The 52-55 range stays in place. There's a slightly bearish potential as the market has fully priced in the OPEC output cut, right? And it's now trading the rising US production, right? That's news, that's fresh. That's something the market can trade from now on. So the risk is slightly inclined towards downside. And if we keep on getting news that US production is rising and will rise more, there's a good chance that the commodity will fall towards the 50 level and even lower. Not much, to be honest. I'm seeing 46, 47. I can foresee at this point a decline back to 25. But beware of that. If, on the other hand, we have news of decreasing production in the US, something quite likely, then the commodity has scope to rise, and it will take a break about 54 to see it retesting the 55.60 region, and even spiking up to 56. But honestly, not seeing much more gains above that level. Would love to see some data from February about OPEC output cut and US production before considering a certain trend in crude oil prices. Okay. In the meantime, range bound to a limited range. Okay. I do believe that's it for today. Thank you guys for being here. Thank you for sharing this time with me. And see you back tomorrow. I will be covering the Fed with, I don't know, Mauricio and maybe Yohai or someone else. And on Thursday, we will be covering the Bank of England. So see you then, okay? Thank you, and bye-bye.